If you make the wrong move with investing, you can lose a whole lot of money. It can be overwhelming with the ever-changing markets and economic landscape, but as long as you stick to some fundamentals, you'll be just fine. In this video, I'm going to be taking you through part 1 of our investing do's and don'ts to help you navigate the world of investing and avoid common pitfalls in 2023 that can cost you money. I'll be doing this by taking you through the do's and don'ts of each asset class. So whether you're a seasoned investor or just getting started, this video is for you. Smash those like and subscribe buttons and let's get right into it. So basically the deal with real estate right now is that prices haven't dropped yet, but interest rates have gone up, which makes loans way more expensive. Plus there's inflation, which could also affect real estate. But it's important to remember that real estate prices tend to move slowly. After the financial crisis, prices slowly dropped over 5 years, and then interest rates went to zero, which caused asset prices to go up. But now we're starting to see a possible long-term decline in real estate prices, and when that happens, commercial real estate can crash quickly. Interest rates are a huge factor when it comes to real estate, and prices might not reflect reality yet. If interest rates stay high, there's a long way to go, with 30-year mortgages now at 6.31% compared to 3.5 or 2.5% earlier. That cheap money caused a real estate price explosion. So now it's a really risky time for real estate in general. But there's always opportunity if you know what you're doing, like selecting the right market and opportunity. But with these higher interest rates, it's harder to find a good deal and structure a good loan. And just think about how much more expensive it is to buy a $500,000 house now with 7.5% interest compared to 2.5%. It's a huge difference, and prices might have to drop a lot to justify these higher interest rates. And also with REITs, it's not worth investing in them with interest rates going up. Even the Vanguard real estate funds have gone nowhere for 5 years just because of interest rates. But remember, investing in real estate depends on the property, loan structure, and cash flow calculations. If you can borrow for a fixed rate and it's a long-term investment, it might still be worth it. But all in all, for 2023 right now, we'd consider real estate investing a don't. Okay, so I know a lot of you are into commodities, and if we look at the commodity index, we saw a big boom in 2020 and 2021 because of inflation, but now it's starting to deflate a bit. Keep in mind though, commodities are priced based on real demand and supply, and short-term trading doesn't really give you a good idea of the long-term picture, so you have to be careful when buying them. For example, iron ore can be really volatile because traders follow the trends, and that causes booms and busts. But it's important to understand what drives the commodity you're interested in. In general, when it comes to commodities, I think it's a good idea to wait for a recession before looking at specific ones. That's when you're able to see which ones are the best to buy, because the cash cost of producing them usually bottoms out at that point, which is a low risk time to buy. But right now we're in a high risk time with maybe some return, but likely a lower return. So don't bother with commodities until we have a good recession. So for commodities, we think it's best that you don't invest right now, but do invest when you see that we have a good recession. So when it comes to the stock market or index funds, what can an investor expect in the short term for 2023? Honestly, it could go either way. If the Federal Reserve lowers rates, inflation cools down, and there's still lots of cash floating around, we can see the market climb back up. But on the flip side, there's also a chance for the market to stay flat or even decline. I'd say there's about a 40% chance of a crash, 10% chance of things going up, and a 50% chance of staying the same. So the odds aren't looking great for the next 12 months. But over the long term, stocks usually go up. If earnings grow slowly but steadily and the price to earnings ratio stays the same, we could see great growth in the next few decades. But it's important to remember that over the last 40 years, stocks have been on a steady upward trend. Sure, there was a decade where things didn't move much, but overall, it's been a rocket ship going higher and higher. So if you're looking to invest in the stock market, you need to have a long-term horizon. It's a great time to buy in, especially if the market dips, but don't expect another decade of rapid growth like we've seen in the past. We're currently a bit down from where we were a year and a half ago, but still much higher than pre-pandemic levels. So overall, stocks are still high, but with a slightly negative outlook. That means do invest in index funds for the long term, but don't invest with the short term in mind. Investing in art can be a good idea, but it's not without its risks. It's important to do your research and invest wisely. Keep in mind that investing in art is different from stocks or other financial assets, and it may not be for everyone. And it may take longer to see a return on your investment. Also, most people buy art because they love it and not for investment, so it's hard to predict the future value of a specific artwork. So do invest in art if it's a passion and you know there's a lot of value there, but don't invest if it's not something you care too much about. Okay, so let's talk about investing in gold. The thing is, gold doesn't actually produce anything, so its value is all based on people's feelings about it. That means it can be great when everyone likes it, but it can also tank for decades if people lose interest. And honestly, it hasn't been doing so hot lately. Plus, it's not like it gives you any cash flow to help protect you from inflation. It's just an asset and it's driven by sentiment. So you have to decide if it's worth it to you. Some people might argue that the Federal Reserve printing more money will make gold more valuable, but look at what happened in 2011. The Fed's balance sheet was at $2 trillion and then it doubled to $4 trillion. But during that time, gold actually went down by almost 50%, so it's not a sure thing. The truth is, nobody knows what gold is going to do next. It's super volatile and you can never be sure. If you really want to invest in gold, do consider looking at gold mining stocks. They pay dividends and can help you navigate the volatility better. But keep in mind, they're still risky and have their own volatility. No matter what, don't get into investing in gold without doing your research and deciding if it's the right move for you. So there are our investing do's and don'ts for the first 5 asset classes. To learn more about the next 5 asset classes, including cryptocurrency, quirky alternative investments, and more, be sure to subscribe to Personal Finance and Investing for Part 2. You definitely don't want to miss out on that. Remember, always do your research, diversify your portfolio, and never invest more than you can afford to lose. And most importantly, don't forget to have fun with it. Happy investing, and I'll see you next time.